Welcome to this edition of Models to Ace. Presenting an Excel spreadsheet-based model to derive the optimum reservation policy for a chartered airline service that will maximize expected profit. Using simulation, an airline runs a chartered flight with 72 available seats. The seats are broadly categorized into two classes, reserved and unreserved. Up to a day prior to the scheduled departure of a flight, seats can be reserved for $360 per seat. The company allows reservations up to a certain limit, not necessarily equal to the capacity of 72. Once this limit is hit, reservations are closed. When such a reservation is cancelled, an amount of $260 per seat is refunded back. The number of reservations requested for a trip follows a discrete uniform distribution, with values from 54 through 99. A passenger who has reserved a seat has a 15% chance of canceling his journey on the flight, thereby forfeiting $100 as cancellation fee. However, if the number of passengers with reserved tickets who show up to 2 hours before the scheduled departure of a flight exceeds the capacity of 72, the airlines has to accommodate the excess passengers on other flights, mostly those of its competitors. It incurs a cost of $400 per such overbooked passenger for these alternative arrangements, thereby losing $40 over and above the ticket price of $360 that it realized from the passenger. If the flight is underoccupied below its capacity of 72 seats, the remaining seats can be fire-sold against requests from unreserved passengers, walking up to its counters at the port of departure. The number of such passengers without prior reservations for a trip closely mimics a normal distribution with a daily mean of 8 and a standard deviation of 4. These passengers are charged $520 per seat on the aircraft. The airlines is obliged to accommodate such unreserved passengers only to the extent of available seats, after accommodating all reserved passengers and accounting for no-shows, up to 2 hours prior to the scheduled departure of a flight. If a reserved passenger is marked a no-show, his ticket is automatically cancelled by the airline, and $260 refunded back. For each trip, the airline incurs a fixed cost of $3,600 per flight and a variable cost of $45 per passenger on board. Clearly, the reservation limit plays a pivotal role in determining the balance between reserved, overbooked and unreserved passengers. This directly influences revenue and margins. The current model would provide insights into the optimal reservation limit against predefined goals of profit or occupancy levels. Reservation limits are considered, starting from 72, all the way up to 99. Let us examine the spreadsheet model, in this tab titled Model Parameters. For a primer on simulation, please refer to the simulation videos under the playlist on project management, on this channel. This table summarizes the micro-factors impacting the target metrics, that is occupancy and profit. This table is replicated from the same table in the last tab, titled Policy Decisions. This cell indicates the cost incurred by the airline for making alternative arrangements per overbooked passenger. This cell indicates the revenue to the airline for each unreserved passenger who has booked a seat in the airline. For each reservation, regardless of whether it gets cancelled or not, the airline collects an upfront amount of $100 per ticket. When the passenger shows up, an additional amount of $260 is earned per each show up. The reservation limit, one that this model will help us determine, is fixed at 90, here for illustrative purposes. Thus, the airline will accept reservations up to a maximum of 90 seats in advance, well above its capacity of 72, indicated here. These are the fixed and variable costs per trip. Among the macro factors impacting demand for seats, the mean and standard deviation for the normal distribution determining the number of requests for unreserved seats for a trip are indicated here. Among the reserved seats, the probability of cancellation is 15%. The number of reserved passengers who show up for a trip varies uniformly between 54 and 99. These tables are supplied values in the last tab, titled Policy Decisions, and the metadata and data get replicated across the remaining 2 tabs, using the assignment operator. For convenient usage in formulae and intuitive understanding, we assign names to these values and ranges using Excel's Name Manager. Let us launch Name Manager and examine these. In this second tab, titled Simulation Model, our model is contained in this table, titled Trip and Occupancy Table. The model simulates 99 trips along these 99 rows. Let us examine data for the first simulated trip. The number of requests for reservations is simulated using Excel's rand-between function that returns a discrete, uniformly distributed sequence of numbers between 2 given numbers. We have supplied the floor and ceiling values of 54 and 99, respectively. Since requests for reservations beyond the reservation limit are rejected, the number of reservations accepted can be elegantly captured by using the min function on the 2 values, the number of requests for reservations and the reservation limit. For a reserved seat, there are only 2 possible mutually exclusive and exhaustive outcomes, either a show-up or a no-show. Since the probability of a cancellation of reservation or no-show and that of a show-up add up to 1, the number of show-ups is binomially distributed with 1 minus the probability of a reservation resulting in a cancellation, applied on the total number of reserved tickets issued. Since these passengers were issued tickets with reservations, the airline is obliged to accommodate every one of these on whether its own flight or alternative ones. Naturally, the excess of these over and above its capacity will result in overbookings. These cost $400 per overbooking, denoted by the name overbook cost, and feed into the total cost, as indicated here. If the number of reserved show-ups is less than the capacity of the aircraft, there will be vacant seats, obtained by the difference between these 2 numbers. Otherwise, there will be no vacant seats. These 2 scenarios can be elegantly reduced to a single formula, using the max function, as shown here. This section of the table, highlighted in dark blue color, denotes the mechanics of unreserved passengers and bookings. This column, under column G, titled Random Hash, contains a normally distributed sequence of numbers using the analysis tool PAC's random number generator. Let us delete these numbers and demonstrate their generation. Launching Data Analysis, under the Data tab, we select Random Number Generation. Since we are generating values for only variable, that is, the number of incoming requests for seats, from unreserved passengers, we supply a value of 1 here, against number of variables. We need 99 generated values for each of the 99 simulations or trials of trips. So we supply a value of 99, here, against number of random numbers. We select the normal distribution and supply the values of 8 for mean and 4 for standard deviation. We set the starting position of the range to cell G3 here, and click on OK to instruct the random number generator to generate the series of numbers. These are the generated random values, normally distributed around a mean of 8 and scattered against a standard deviation of 4. Let us pause while the numbers get generated by the random number generator. This non-integer value is converted to an integer here. Obviously, How many of these requests can be accepted depends entirely on the number of vacant seats left, after accommodating all reserved passengers and accounting for no-shows, up to 2 hours prior to the scheduled departure of a flight. This value is obtained by using the min function upon the number of vacant seats available and this number of incoming requests from unreserved passengers. The number of seats eventually occupied, taking into account the number of unreserved passengers granted seats, is obtained by taking the capacity of the aircraft, striking of the vacant seats and adding the number of unreserved passengers granted seats. This results in the utilization level of the aircraft. The airline accrues revenue from 3 sources: the cancellation fees from reserved passengers who end up as no-shows, the reserved passengers who show up, and finally, the unreserved passenger who are issued seats. Accordingly, the numbers in each of these categories are multiplied by the corresponding revenue rates per seat and summed up, to obtain the total revenue. The costs are incurred for the flight operated by the airline, as well as on making arrangements for overbookings on alternative airlines. On its own airline, the company incurs a fixed cost and variable cost per passenger summed over the number of passengers on board. On overbookings, it incurs a cost of $400 per each overbooked passenger. The difference between revenue and costs is obtained to arrive at the final profit for the trip. Having modeled the first trip, we can replicate these for the remaining of the 98 trips, simply by selecting the first row and either manually dragging it over the remaining 98 rows, or automating the drag operation by double-clicking on this bottom right-hand corner of the selection. For the latter method to work, we must have non-blank values in this preceding first column, occupying as many contiguous rows as the number of replications we want. This column is obscured from view by setting the font color to the same as the cell background color. It is further obscured by reducing the column width. We can generate this by using the fill operation, under the Home tab, under the section named Editing. Launching the Fill Series dialog box, we select a linear series to be filled along a column, with the starting value of 1 and an ending value of 99. Having generated these 99 values, let us clear out the values in the 98 rows, below the first row we examined. We now select the entire first row and double-click on this bottom right-hand corner of the selection. Thus, this table of simulated values is generated for 99 trips. The range of cells containing this set of consequent occupancy levels is named Array Occupied Seats using Excel's Name Manager. Similarly, the range of cells containing the profits is named Array Profit. The averages of these values are indicated in these 2 cells, using Excel's average function, operated upon the 2 arrays we examined. Since these 2 averages are obtained upon 99 random trials, these are close to the expected values of the 2 statistics, utilization and profit. In this last tab, titled Policy Decisions, we run this simulation model, against all possible reservation limits, under consideration to determine the corresponding values for average profit and occupancy. We then plot these on graphs and observe trend behaviors to determine the optimal values. The values are tabulated in this range of cells. Along this column, we list out the values of reservation limits, under consideration, which range from 72 through 99. Under this column, we point this cell to the value of average profit, produced by the simulation model, in the previous tab. In the next cell, we point to the corresponding value of average occupancy. Instead of manually changing the value of reservation limit and invoking the simulation model 27 times, we will use Excel's data table to automate the generation of this table. Selecting this range of cells, we launch data table from the What If Analysis section. Note, each invocation of the simulation must be supplied the reservation limit as input. So, we set this value of column input cell to the value of reservation limit and instruct data table to auto-generate output values. This table plots the average profit against the range of reservation limits, along with this trend line, using data in these first 2 columns of the generated table. Similarly, this table plots the average occupancy against the range of reservation limits, along with this trend line, using data in these first 2 columns of the generated table. Since average occupancy is not a sorted list, we reproduce these two columns in this table below and sort the column of average occupancy. This is used to plot this last line graph, along with this trend line. Thank you for giving Models to ACE the opportunity to serve you with our analytical models. Please subscribe to our channel for more.